Today we are joined by Stephen Nash from FIIG Securities. Good morning to you over there, Stephen. First of all, are we likely to see a more dovish tone from the central bank than those minutes we got, or the statement we got, back earlier this month, which was certainly a very short one?
Yeah, some have interpreted the shorter statement as indicating that there wasn't much change in economic conditions, so it didn't really justify a longer statement. I think there's also probably a little bit of disagreement between board members who I think are a little bit more dovish and want to provide more easing, particularly to the manufacturing sector, and the administration who remain a little bit on the hawkish side. I would have thought that there may be acknowledgement of the underlying problems that the manufacturing sector are having, particularly with the higher Australian dollar, although that's been eased somewhat of late. Still probably not enough for a lot of the board members. We might see a little bit of a dovish tinge in those minutes today.
Okay, let's go to a different central bank, the US Fed. Overnight, we saw an incredible plunge in the Dow Jones on the back of an article in the Financial Times, down about 100 points, basically just suggesting that Bernanke could indeed start tapering back, or could start tapering back those bond purchases come September. Nothing new in the article. There wasn't any sources or leaks from the central bank. Why did the market react so harshly?
Look, I think the market's really been distracted from focusing on the economy to focusing on the Fed and what the Fed is going to do. I think in terms of bond markets trade on what the fundamentals are, and if anything, those fundamentals are starting to get a little bit weaker. You know, if you look at these Fed surveys that are coming out, the New York Fed, for example, the underlying components of that are quite weak, and I think they're really showing what's going on in terms of underlying activity in the US. And that, if anything, that's trending a little bit lower. So I think the focus on what the Fed is going to do is really a distraction, and the market, it will eventually refocus on what's going on in the economy, and there's not much good news there right now.
Yeah, what about bond markets? How did they react?
We saw a little bit of a rise in 10-year yields, but nothing dramatic. I think the main implication here is what's been going on in the US mortgage market, and the 30-year mortgage market there indicates that rates are now 50 basis points above the high since mid-2012. So that really indicates the market has really built in a tightening already in terms of what the Fed's going to do. It's really a question of what happens next, whether further tightening is justified. I think what the Fed will do will try to alleviate that and try to bring those mortgage rates back down so that the housing recovery is not stalled at this point.
Okay, Stephen Nash, FIIG Securities,
Okay.
Thanks for your time.
Thank you.